Hello there, and welcome to the latest episode of Mondays with Matthew. Now, regular viewers may remember that last week I addressed the significant changes being seen in the jumbo mortgage arena. Well, this week I'm going to continue my focus on housing finance, but this time I'm going to turn my attention to the conforming mortgage market and the recent volatility that we've seen in mortgage rates over the course of the last 5 or 6 weeks. Then I plan to finish off with my forecast for mortgage rates for the balance of 2020. However, before I dive in too deeply, I am going to take just a moment to explain exactly how 30-year mortgage rates are set. Now, of course, there's a lot of factors that go into the rate that an individual home buyer is quoted. Things such as credit quality, down payment, whether it's a primary or secondary home, as well as the market appetite for mortgage bonds at the time. But for the purposes of this discussion, I'm going to focus on how the core rate is set. So 30-year mortgage rates are set in direct relation to the yield or the interest rate on the 10-year Treasury note. Of course, some of you may say, well, hang on a second, I've got a 30-year mortgage, so why doesn't that track 30-year bonds? And to be truthful with you, that's actually a pretty decent question. However, given that on average, we either move or refinance our homes every 10 years, the 10-year bond is the foundation for the interest rate even on a 30-year mortgage. I'd also add that although mortgage rates are set based on the 10-year Treasury, the actual percentages for bonds and mortgages are never going to be the same. And this is because there is always some risk associated with a mortgage as opposed to a bond, which has no risk. So therefore, the interest rate for mortgages will always be higher than the corresponding bond rate. So, with the knowledge that mortgage rates follow bond yields, it makes sense that when the economy is strong, the interest rate on bonds rises, which therefore pushes mortgage rates higher. And conversely, when the economy is weakening, well, the opposite applies and mortgage rates tend to drop. Okay, so that's essentially how mortgage rates are set. So now let's discuss what's been going on with rates recently. As we are all painfully aware, a little over a month ago, the nation experienced what I believe to be the fastest economic adjustment the world has ever seen. The COVID-19 outbreak caused a massive sell-off in the stock market, and if you remember what I just said about the relationship between stocks and bonds, we saw a huge move out of equities and into the relative safety of US Treasuries. With a massive increase in demand for bonds, the interest on them dropped, and they dropped dramatically, which led mortgage rates to fall almost as quickly. So much so that the 30-year fixed mortgage hit all-time lows the week ending March 6th. At this point, many analysts actually believed that mortgage rates were going to continue to drop even further, which in theory was not an unreasonable assumption given what was going on in the economy at the time. But no, mortgage rates started to rise just a little over a week following hitting their all-time lows. So what was going on? Well, it's interesting because rather than demand growing for bonds, which would make total sense as the country was starting to grind to a halt, we actually saw investors selling mortgage bonds and moving into cash, the ultimate safe haven. So with demands for bonds dropping, yields or the interest rate rose to try and attract more buyers. At the same time, buyers of mortgage bonds were also getting scared as they were seeing a wave of refinance activity because of the historically low interest rates which were seen at the time. And their concerns were certainly legitimate, as they believed that if rates dropped even further after they bought the bonds, well, homeowners may refinance, and that mortgage would leave the bond pool, and the bondholder would therefore lose that income. So with more bond sellers than buyers, yields jumped, went skyward, and mortgage rates clearly it made sense for them to follow suit, which is what they actually did. So that is, in essence, why we experienced some extremely sharp moves down to start with, and then back up in mortgage rates in March of this year. Well, that was then, and this is now. So where can we expect to see rates moving for the rest of the year? Well, we saw that spike and they have certainly pulled back and moved lower from that point onwards. But the real answer for the balance of the year is no one can be quite sure, at least until two very important questions get answered. And the first one is this: how badly will mortgage lenders, and especially mortgage servicers, be affected by what's currently going on in the economy? To accurately forecast rates, I've got to assume that a large majority of them will survive the current economic crisis, although many, I'm sure, would likely feel more than a little beaten up. The second question concerns homeowners who have chosen the route of forbearance. Now again, I've got to assume that they will come out of this program and resume making mortgage payments in a way that keeps their mortgages in good standing and, more importantly, allows those loans to move freely in the secondary mortgage market. So, given these assumptions, and there are some pretty big assumptions to make in regard to lenders and homeowners, and with the belief that the country will reopen, relatively speaking, shortly, I'm looking for rates to remain in a pretty narrow band for the next several weeks, based on where they are today. However, after that, I expect them to start to trend lower. Now, at this point, I don't expect the 30-year breaking south below 3%, but we are quite likely to retest the 3.1% lows that were seen in the first week of March. Now, I hope you found today's comments of interest. As always, if you have any questions or thoughts about this topic, I would love to hear from you. But before I leave, I would ask if there is a subject that you would like me to address in a future commentary, please let me know and I'll try and cover it in a later video. So take care of yourselves, and I do look forward to visiting with you again next week.